to PhillipCapital Weekly Market Watch. I'm Lin Sin from Phillip Securities Research. Today, we will be discussing on the Hong Kong Shanghai Stock Connect, also known as the True Train Program, and some of the background information before investors jump on board. Hong Kong and Shanghai Stock Connect program will open the previously closed A-share market to offshore investors, which foreign investors to date can only buy yuan shares listed in Asia's second largest stock market through the Qualified Foreign Institutional Investor (QFII) and Renminbi Qualified Foreign Institutional Investors (RQFII) programs. In essence, the True Trade program will allow Hong Kong-based investors with or without their own QFII licenses to access the Shanghai Stock Exchange and mainland investors to invest in Hong Kong equities subject to daily and aggregate quotas of Renminbi 13 billion and Renminbi 300 billion for northbound trades and Renminbi 10.5 billion and Renminbi 250 billion for southbound trades. Foreign investors through the link will be accessible to Shanghai listed stocks, which account for about 90% of the exchange total market value and 80% of average daily turnover. The scheme will coexist with Qualified Domestic Institutional Investor (QD), as well as QFII and RQFII mentioned before, but complement the existing programs by allowing for greater retail investor participation and easier market access, as well as attracting greater liquidity to both Hong Kong and Shanghai. Even after the implementation of Stock Connect, there will still be demand for QFII quota, as it allows investors to trade other products such as Shenzhen's listed stocks and convertible bonds, which Stock Connect presently doesn't cover. In addition, for investors to trade through Stock Connect, both the Shanghai and Hong Kong exchanges need to be open on that particular day. Nonetheless, from an investment perspective, the scheme will bring greater liquidity to both Hang Seng and Shanghai. For Hong Kong, this should strengthen its position as a gateway to China-related investment, reinforcing its leader position in offshore renminbi trading, A-share, and dim sum bond investment. For Hong Kong investors, the program offers a direct and convenient way to gain exposure to A-shares, allowing them to better diversify portfolio. For Shanghai, the scheme will strengthen its position as an onshore financial hub, complementing the establishment of the free trade zone. From a macroeconomic perspective, the Hong Kong-Shanghai Stock Connect represents another push to liberalize China's capital account. The exchange link would not just help to liberalize China's financial system, increase the role of the yuan, it also provides its citizens more investment channels amid a slumping property market and increased risk from local wealth management products. Greater cross-border capital flows can deepen China's asset markets and allow local investors to expand investment offshore. Investors' interest would be to ride on the arbitrage opportunity on the dual-listed stocks. As the A-shares Chinese stocks are restricted to the domestic market, it has a slower reaction to the market movement and are mostly trading in a discount to its H shares. Investors betting the link will help to narrow the pricing gap between the two exchanges. The Hang Seng China AH Premium Index, where 100 indicates prices between dual-listed stocks are equal, advanced to a high of 97.7 in May. At here. After the plan's initial announcement, the gauge is now trading at around 96 here and has averaged 95.51 in the year to date, indicating that there are still arbitraging opportunities. Value investors may also tap on this channel to access to non-financial blue-chip A-shares that are not listed in Hong Kong but with attractive valuations. However, many key questions remain unanswered, such as whether the broker should withhold 10% of the capital gains tax. China has a 10% capital gains on all stock purchases made on the mainland, but this tax has never been collected on shares purchased under a range of cross-border foreign investment programs, including the Q fee and RQ fee. It also has a dividend tax ranges from 5 to 20%, depending on the length of holding period. Meanwhile, mainland investors trading in Hong Kong will not have to pay capital gains tax, as Hong Kong does not impose any type of capital gains tax on shares purchases. Despite some problems faced, including settlement, custody system, and costs, market participants are actually optimistic that it will go online as scheduled on mid-October, or tentatively on October 13. If successful, subsequent actions could be taken. First, expand the trading quota. 2. Bring Shenzhen into the scheme. And 3. Expand the product coverage to include fixed income and other financial assets. It may also result in the inclusion of A-share market into the MSCI indices, which will then attract more investment inflows. So this is just a brief snapshot of the Shanghai Composite Index. Although the pilot program linking the Shanghai and Hong Kong exchanges ramped up the benchmark Shanghai Composite Index, we remain cautious on the economic fundamentals which underpin the country's growth. Economic and cultural structural reforms are crucial for China, benefiting the nation as a whole, domestically as well as to foreign investors, thus lifting investors' spirit. Slower growth is now the new normal for Asia's growth engine. With the economy experiencing growth moderation and structural reform, the performance of Chinese stock markets will likely to be driven by policy. This would be a turning point for China. It would be a challenge to the authorities to balance between the reforms and sustaining the economic recovery. While we see some downside surprises in July and August, despite a burst of government stimulus measures, the patchy economy recovery suggests more policy support may be needed to keep growth on track as a property downturn worsens and continues to be a drag on its economy. Although we expect more targeted measures to be rolled out in near term to shore up growth, boost the stalling in domestic demand, and bolster the economy from hard landing, economic growth would continue to moderate as the impact from the impending new stimulus measures may not be as significant as in the second quarter of this year. We are optimistic that global economic recovery remains intact, and thus the momentum in the region's manufacturing sector, but headwinds persist. A strong and sustainable pickup may be still some way away. A premature tightening of US interest rates would send a jolt to the market. On the flip side, tighter monetary policy will also signal a US recovery, which should bode well for the region's exports. As such, barring from unforeseen significant external downturn, and with optimistic reforms leveled out by new administration, we upgrade China from neutral weight to overweight. But we remain cautious on the risk of reforms being delayed and how reforms interact amid a depressed growth and an elevated credit risk. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Securities Research. Tune in for more Market Watch videos.